This segment is sponsored by Davidson Capital Management.
Investing wisely to your portfolio is very crucial. So in today's Money Wise Wednesday, we have some tips on what to avoid when it comes to investing. Here's the Davidson Capital Management team with more.
Anytime I sit down with a prospective client, the first thing I always like to do as far as providing them education is one of the fastest ways to add money to the value of your portfolio. It's not performing well in the stock market or in the bond market. It's actually keeping your management fees or the overall fees you're paying in your portfolio lower. So for all investors, if you want to avoid being a terrible investor, kind of rule number one is do not pay high fees. And you have to ask those questions about how much you're paying per year in your portfolio as far as in total management fees. Second way to be a terrible investor is not paying attention to taxes, or should I say unrealized gains in a taxable portfolio. I see individual investors coming in and they have multiple individual stock positions or exchange traded fund positions or mutual fund positions that they have owned for a multitude of years that have continued to amass over the years very large unrealized gains. So what that means is that if an individual investor wanted to make an investment change, it prevents them and sometimes becomes a barrier for them to want to make a change in their portfolio because of the huge tax burden they're going to get hit with taking that unrealized gain and turning it into a realized gain. And this is important for anyone that has a taxable investment account. So you have to pay attention to your unrealized gains. The next point to not become a terrible investor is trying to time the market. Now, an old saying we use here at Davidson Capital Management, it's not timing, it's time in the market that truly counts and what builds long-term wealth in any portfolio. What a terrible investor does from a timing of the market perspective is it's the all-in, all-out strategy. If you just miss 3 best up days in any given market year or market cycle, it can significantly impact the total value of your portfolio over the life of the account. So remember, you have to maintain that long-term perspective. The fourth way to avoid becoming a terrible investor is chasing returns. So if small cap value did great last year, we don't recommend you shift all of the stock allocation you want to have in your portfolio all over to small cap value because it had a great year. The odds of it having 2 great years back to back are extremely small. The fifth and final way to avoid becoming a terrible investor is having a short-term investment focus. Don't allow a short-term market event drive you to make a decision with long-term assets. You have to maintain that longer-term perspective, but like I've said in the past, you don't want to have complacency in your portfolio. Active management is the key. If you'd like to learn more about us, you can go to our website at davidsoncap.com where you can subscribe to our podcast.
And for more information, here's that website for you. It is davidsoncap.com. You can also call the 800 number on your screen, 800-275-2162 for more information.